Okay, so today I wanted to share with you guys the latest Halifax House Price Index data to show you guys the current state of play in the UK property market. We'll touch on the data and what it means. We'll also discuss some of the property market forecasts for 2023, along with the impact of the decisions made by the Bank of England just last week. So after 4 straight months of house price declines up until December 2022, as of January 2023, house prices actually remained stable month on month. There was absolutely no change in the average house price, neither to the upside or to the downside, and now the average house price sits at £281,684. This might certainly have come as a bit of a surprise to you, considering the fact that the UK property market certainly looks like it's going through a cycle of contraction. But when we actually look at the detail within the report, the director of Halifax Mortgages actually said that the pace of annual growth has continued to slow to 1.9%, which is the lowest level recorded over the last 3 years. So whilst house prices didn't exactly come down in January, we're still seeing slower growth rates in comparison to this time last year, which certainly backs up the point around the property market not exactly being buoyant right now, especially considering what it was like during the pandemic. The director goes on to say that the average house price is now around £12,500, the equivalent to 4.2% below its peak in August last year, though this still remains some £5,000 higher than what it was in January 2022. So whilst house prices are still higher than what they were this time last year, they are falling quite quickly. And in the coming months, I suspect that it's likely that house prices will continue to fall after this kind of post-Christmas, post-New Year house price selling frenzy is actually finished. Because the truth of the matter is, higher borrowing costs have certainly reduced demand, and we'll touch on a little bit more of the detail on that in a minute's time. But firstly, I was listening to the property podcast yesterday, and they actually referenced something called the 18-year property cycle, which I wanted to discuss. It was developed by someone called Fred Harrison, who studied literally hundreds of years worth of historical market data, and he came to the conclusion that the UK property market typically operates within 18-year cycles. And generally speaking, by and large, it's been fairly accurate, to the point where Harrison was able to predict the 1990s market crash, along with the 2008 market crash as well. And between now and 2026, we could very likely see the next crash actually playing out. Let me show you what the cycle is in theory. So the way it works is you have 14 years worth of booming market conditions with a mid-cycle wobble followed by 4 years of a market crash. Now when we apply that theory to the current market cycle, considering that the 2008 market crash was the end of the previous cycle, and actually the 2009 lows, as we had that kind of transitionary period, was the start of the first 14 years worth of boom thereafter. That pretty much takes us up until now. So technically speaking, anytime between now and probably about 2026 could be roughly about those 4 years worth of market crash to align to the cycle. Which is very interesting because it actually aligns to what the Bank of England have just said just last week in relation to interest rates within this current cycle in the coming years ahead. But hold that thought, because we're going to touch on that in just a minute as well. But I think what's really important to call out is that the property market won't go on to just crash in kind of an emphatic fashion. In my opinion, I think it's going to be a fairly slow tapering off of prices over the coming years ahead. It may be a case where, like we've seen this month, that there's just no change in property prices at all. And because of that, property prices may actually come down quite steadily. But I think overall, when we kind of step back in a few years' time and look at this property market cycle, I do still think we'll have a sizable decline on our hands in percentage terms. I just don't think it's going to be quite as rapid as perhaps as what we saw back in 2008. Here's what the CEO of Lloyds Banking Group had to say when he was in Davos just a couple of weeks ago.
The other challenge a lot of our customers are focused on is house prices, and we do see house prices softening about 8 to 10% this year.
So an 8 to 10% contraction in 2023 is Lloyds Banking Group's base case. Now that is on top of the 4.2% decline which we already saw at the back end of last year. Now, if that base case is accurate, then that would take your average house price down to anything between roughly about £253,500 to about £259,000, which is roughly about £35,000 to £40,000 below that of the previous peak property prices in August of 2022. So if that discount, if you like, applied, that certainly makes up for some of the affordability loss that we've had over the past couple of years with property prices absolutely booming. So it's probably quite obvious that house prices are directly correlated to affordability. And with real post-tax household income growth actually dipping into the negative as at recent reporting, so if real incomes actually not increasing, it's highly unlikely that the property market and asset prices more broadly will continue to rise during this period. Notice on the chart as well how real income growth fell in a similar fashion back in 2008, and we all know how the property market collapsed during that period of time, and it also kind of makes you think back to that alignment point around the 18-year property cycle and the kind of parallels that we've got going on. But it's not just income growth rates being on the decline that's actually hurting affordability based on broader macroeconomic issues, but it's also the fact that the Bank of England are actually increasing interest rates that's hurting affordability too. Just last week, the Monetary Policy Committee agreed by a 7-2 split that the base rate should be increased to 4%. And that's the highest rate we've seen since 2008. Now, the latest bank rate forecasts, which are kind of being priced in financial markets, is that we'll see a terminal rate to the top end of the Bank of England base rate, topping out at about 4.5% in mid-2023, before then starting to taper off into 2026, down to about 3.25%, which again would largely align to the 18-year property cycle. Because when rates go up, affordability goes down and therefore house prices will come down too. Whereas when everybody finally adjusts to these new higher rates and then the Bank of England say, okay, actually we've finished this period of hiking rates now and we've stabilized inflation and now we can reduce our interest rates, then people will probably start to feel a little bit more flush and feel like they can afford more property in terms of the absolute value, because the interest rates on their mortgage payments will be a little bit lower. And therefore that increase, if you like, in affordability 2 to 3 to 4 years down the road could actually stimulate the housing market and house prices could actually rise once again. So I don't know about you guys, but I can certainly see some parallels between the 18-year property cycle and kind of what's going on with the Bank of England and monetary policy as of right now. Now, what I will say is I think it's probably natural for us as human beings to try and identify with trends and patterns in kind of markets, whether that's the housing market or financial markets, to help kind of justify and forecast some of our financial decisions. Whether those patterns and trends are actually there or not in reality, well, I'll leave that down to you guys to debate the validity of them down in the comment section below. But back on the topic of rates and how they actually impact me and you guys, I think what we can certainly observe is that interest rates always go up very quickly, but they don't come down as quickly. So in the short term, it's great for savers, but not so good for borrowers. Even when we look towards the mortgage market, and there's certainly been some positive movement in mortgage rates in the past couple of weeks, past month or so if you like, but they're still materially higher than what they were 12 months ago. To give you guys a real life example, I'm currently on a 2-year fixed rate mortgage at 1.19%. However, that 2-year fixed rate mortgage has now come to an end and I've been offered a new interest rate of 5.09%. In hindsight, I should have locked in that interest rate 2 years ago, but I wasn't to know that there was going to be a global pandemic and inflation rates above 10%. However, a bit of a tip for you guys if you are coming to the end of your fixed rate mortgage is to keep going online and actually checking interest rates. Because for me, I actually didn't secure an interest rate of 5.09% straight away. Actually, 2 or 3 months ago in November, I actually secured an interest rate of 5.94%. However, financial markets have adjusted to potentially a slightly lower Bank of England base rate forecast, and because of that, mortgage rates have tapered off just a little bit. So because of that, I contacted my mortgage provider, knocked off close to 1% and saved myself the equivalent to about £100 a month. So if you are in the process of renewing your mortgage, then be sure to keep your eye out. The knock-on effect of these higher rates is that the banks simply aren't lending out as much money as they were before. Mortgage approvals are actually sharply on the decline. We're actually heading towards the lows of the pandemic and pretty much in line with the approval rate last seen in 2008, all of which suggests with affordability rates massively on the decline that house prices will need to proportionately adjust themselves to meet that new level of affordability. If home buyer affordability has fell, let's say 10%, then I think it only goes on to make sense that we could at least be looking at a 10% decline in market prices too. But with all that said, that's very much short-term thinking and thinking about the here and now. And I know whilst that's massively impactful for so many people out there, I think it's also still worthwhile to take a step back where we can and analyze the bigger picture. Because what I'm about to share with you guys will probably blow your mind just as much as it did mine. I actually look back at the historical central bank base rate between 1694, so over 300 years ago, up until today. And the data shows that the average central bank base rate is actually 5.91%. And again, at a bigger picture level, house prices have always continued to go up in value over time. And that's even when you look at periods of time in the market where the central bank base rate was in double digits. Pretty much all throughout the 70s, most of the way throughout the 80s, and even in the early 90s as well. And you can see that during that time, by and large, house prices continued to rise, despite mortgage rates, I assume, being ridiculously high. Certainly far higher than what I could comprehend just being a homeowner over the course of the past few years. And I know there's certainly that debate around affordability back in the day versus what it is now, which is why I've discussed it somewhat during this video. But I think there will always be an underlying point when you take a step back and look at the bigger picture that UK property as an asset class still remains a very resilient asset that over the long run actually provides a very good return on investment. So look, that's my views on the current state of play in the UK property market as of right now, and be sure to let me know what yours are down in the comment section below. And in light of the higher mortgage costs which we're all experiencing right now, I actually made a video about whether you should either overpay your mortgage or invest the money instead. So be sure to click on that video next, and with that being said, I'll see you over in the next one.